What is Forex trading? Forex trading is the simultaneous buying of one currency and selling of another. Currencies are traded through a Forex broker or CFD provider and are traded in pairs. Currencies are quoted in relation to another currency. For example, the euro and the US dollar, euro to US dollar, or the British pound and the Japanese yen, pound sterling to Japanese yen. When you trade in the Forex market, you buy or sell in currency pairs. Imagine each currency pair constantly in a tug-of-war, with each currency on its own side of the rope. An exchange rate is the relative price of two currencies from two different countries. Exchange rates fluctuate based on which currency is stronger at the moment. There are three categories of currency pairs: the majors, the crosses, the exotics. The major currency pairs always include the US dollar. Cross-currency pairs do not include the US dollar. Crosses that involve any of the major currencies are also known as minors. Exotic currency pairs consist of one major currency and one currency from an emerging market, EM. Major currency pairs. The currency pairs listed below are considered the majors. These pairs all contain the US dollar, USD, on one side and are the most frequently traded. While there are 8 major currencies, there are only 7 major currency pairs. Compared to the crosses and exotics, the price moves more frequently with the majors, which provides more trading opportunities. The majors are the most liquid in the world. Liquidity is used to describe the level of activity in the financial market. In Forex, it's based on the number of active traders buying and selling a specific currency pair and the volume being traded. The more frequently traded something is, the higher its liquidity. For example, more people trade the euro to US dollar currency pair and at higher volumes than the Australian dollar to US dollar currency pair. This means that euro to US dollar is more liquid than Australian dollar to US dollar. Major cross-currency pairs or minor currency pairs that include any two of the major currencies except the US dollar are known as cross-currency pairs or simply as the crosses. Major crosses are also known as minors. While not as frequently traded as the majors, the crosses are still pretty liquid and still provide plenty of trading opportunities. The most actively traded crosses are derived from the 3 major non-USD currencies: Euro, JPY, and GBP. Exotic currency pairs. No, exotic pairs are not exotic belly dancers who happen to be twins. An exotic currency is a currency from countries with developing or emerging markets. Exotic currency pairs are made up of one major currency paired with a currency of an emerging economy, such as Brazil, Mexico, Indonesia, Poland, Chile, Turkey, or Hungary. Basically, an exotic currency pair includes one major currency alongside an exotic currency. The chart below contains a few examples of exotic currency pairs. Want to take a shot at guessing what those other currency symbols stand for? Depending on your Forex broker, you may see the following exotic currency pairs, so it's good to know what they are. Keep in mind that these pairs aren't as heavily traded as the majors or crosses, so the transaction costs associated with trading these pairs are usually bigger. It's not unusual to see spreads that are 2 or 3 times bigger than that of euro to US dollar or US dollar to Japanese yen. Due to the overall lower degree of liquidity, exotic currency pairs tend to be far more sensitive to economic and geopolitical events. For example, a political scandal or unexpected election results can cause an exotic pair's exchange rate to swing violently. So, if you want to trade exotic currency pairs, remember to factor this into your decision. For those of y'all who are really mesmerized by exotics, here's a more comprehensive list. Aside from the 3 main categories of currency pairs, there are other groups of currencies that are thrown around in the FX world that you should be aware of. G10 currencies. The G10 currencies are 10 of the most heavily traded currencies in the world, which are also 10 of the world's most liquid currencies. Traders regularly buy and sell them in an open market with minimal impact on their own international exchange rates. The Scandies. Scandinavia is a subregion in Northern Europe with strong historical, cultural, and linguistic ties. The term Scandinavia, in local usage, covers the 3 kingdoms of Denmark, Norway, and Sweden. Together, their currencies are known as the Scandies. Back in the day, Denmark and Sweden established the Scandinavian Monetary Union to merge their currencies to a gold standard. Norway joined later. This meant that these countries now had one currency with the same monetary value, with the exception that each of these countries minted its own coins. But then World War I happened. The gold standard was abandoned and the Scandinavian Monetary Union disbanded. These countries decided to keep the currency, even if the values were separate from one another. And this remains the state of things. If you notice their currency names, they all look similar. That's because the word krone or krona literally means crown, and the differences in spelling of the name represent the differences between the North Germanic languages. Crown currencies. What a cool name, huh? I don't know about you, but saying "hook me up with some crowns, yo" sounds way cooler than "hook me up with some dollars, yo." SEK and NOK also have cool nicknames, Stocky and Noki. So when paired with the US dollar to Swedish krona is red dollar Stocky, and US dollar to Norwegian krone is red dollar Noki. CE currencies. CE stands for Central and Eastern Europe. Central and Eastern Europe is a term encompassing the countries in Central Europe, the Baltics, Eastern Europe, and Southeast Europe, the Balkans, usually meaning former communist states from the Eastern Bloc, Warsaw Pact in Europe. Central and Eastern European countries, CEECs, is an OECD term for the group of countries comprising Albania, Bulgaria, Croatia, the Czech Republic, Hungary, Poland, Romania, the Slovak Republic, Slovenia, and the three Baltic states, Estonia, Latvia, and Lithuania. Regarding the FX market, there are four main CE currencies to be aware of. BRICS is the acronym coined for the association of six major emerging national economies: Brazil, Russia, India, Indonesia, China, and South Africa. Originally, the first four were grouped as BRIC, or the BRICS. BRICS was a term created by Goldman Sachs to name today's new high-growth emerging economies. BRICS is the term created by the OECD when it added Indonesia and South Africa. BRICS Plus. At the September 2023 BRICS Summit, leaders announced an expansion of the bloc by inviting 6 new countries to join as full members from January 2024: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. However, following Argentina's change in government, it ultimately declined the invitation. As a result, Egypt, Ethiopia, Iran, Saudi Arabia, and the UAE joined the original BRICS group: Brazil, Russia, India, China, and South Africa, bringing the total to 10 members. In January 2025, Indonesia was officially admitted as a full member, expanding the group to 11 countries. The BRICS Plus countries vary significantly in their economic and demographic impact, but their combined influence has grown substantially. The expanded BRICS Plus group now represents approximately 46% of global GDP, adjusted for purchasing power, and about 54.6% of the world's population. In addition to full members, BRICS introduced a partner country category in October 2024. 9 countries have been granted partner status: Belarus, Bolivia, Cuba, Kazakhstan, Malaysia, Nigeria, Thailand, Uganda, and Uzbekistan. Nigeria, Africa's most populous country, joined as a partner on January 17, 2025. With over 30 countries expressing interest in joining BRICS, either as members or partners, the group's economic and political importance is likely to continue growing in the coming years.
Summary. Phew.
That was a lot of information on currencies, but you just raised your FX IQ points. Let's summarize what you've learned in a series of questions. What is a currency pair in Forex? A currency pair is a pairing of currencies where the value of one is relative to the other. For example, pound sterling to US dollar is the value of the British pound relative to the US dollar. What are the major currency pairs? Major currency pairs, majors, are those that include the US dollar and are the most frequently traded. There are 7 of them: Euro to US dollar to Japanese yen, pound sterling to US dollar to Canadian dollar, US dollar to Swiss franc, Australian dollar to US dollar, and NZD/USD. What are the currency crosses? Currency crosses are the more frequently traded currencies that do not include the US dollar in their pairing. Crosses include Euro to pound sterling, euro to Canadian dollar, pound sterling to Japanese yen, euro to Swiss franc, euro to Japanese yen, etc. How many currency pairs exist? There are hundreds of currency pairs in existence, but not all can be traded in the FX market. The United Nations currently recognizes 180 currencies. If you were to pair each currency up with another, it's a lot.